Welcome to the Nichols Tax Update Podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I, by the way, always acknowledge the value of my subscription to Tax Notes Today, published by tax analysts, the preeminent source of information for tax professionals in the preparation of this program. With that noted, let's proceed. What's here? What's in this edition? 7 items, so it's an average week. We have been as low as 4, I think, and as high one week as 12, which was really a busy week. Anyway, we got final like-kind exchange regulations that define real property and give us a little guidance on when something that is attached is part of the real property. And that's important if you want to do a 1031 tax-deferred exchange, which can only be done for real property. Then we get final exempt organization executive compensation rules. In case you have an exempt organization that needs to pay an executive more than $1 million a year, you need to know these rules. I don't have any of those, but you might. Then we have the case of an S corporation that tried to claim credits, pass those through to its owner, when in fact they weren't entitled to claim the credits. These are research credits that can't be claimed unless the S corporation gets substantial rights in the research. Final regulations on deductible penalties. We all need to know that. That's part of the toolbox. When is a penalty paid by your client deductible and when is it not? Then a strange case, not strange, because if you know partnership rules, you know that this was the only reasonable outcome. Partner contributions were really loans. 3 partners didn't put anything, 1 partner put in everything. Those were loans. When they weren't paid back, that's treated as debt forgiveness income is recognized at the partnership level. We'll talk a little bit about that, but the 3 partners who didn't put in any money had income when the partner who did put in the money was not repaid. Final regulations on health reimbursement arrangement integrated with Medicare or other account-based individual group coverage. That's important if you're worried about your Obamacare compliance. That can be really tricky. And finally, Exxon had a reasonable basis for a tax return position, and it was not a change in method of accounting. This is under the old law, pre-2015 law, but I want to talk about it because it does a really good job of discussing the concept of reasonable basis. So let's get started. Like-kind exchange regulations, section 1031, 1.1031-0 et sequitur. Property is real property if it meets the following requirements. If it's real property under state and local law, if it's listed as real property in the final regulations, and there is a list of assets that are always real property under 1031 in those final regulations, or it's considered real property based on a facts and circumstances test in the final rules. And I talk about that on the next slide. But before we go there, I want to touch on this issue of cost segregation studies. The effect of a cost segregation study on the classification of property as real property under 1031, it's still real property, even if you did a cost seg study and you took bonus depreciation on some part of the real property which you classified as tangible personal property for purposes of the cost seg study. That makes sense, right? Facts and circumstances test for distinct asset as opposed to part of real property. My recollection is this is nothing that's particularly new. I thought this had been around for a time. Whether the item is customarily sold or acquired as a single unit rather than as a component part of the larger asset. We're trying to figure out whether a particular item is real property, whether the value of that item is real property and can be included with real property in a 1031 exchange, whether the item can be separated from a larger asset, and if so, the cost of separating the item from the larger asset. A sign, which is affixed to the side of the building with with bolts and bricks, and it would destroy the side of the building if you took the sign off. The sign is part of the real property. Another sign that's mounted on the roof that you can pick up and move might not be real property. Whether the item is commonly viewed as serving a useful function independent of a larger asset of which it is a part, and finally, whether separating the item from the larger asset of which it is a part impairs the functionality of the larger asset. Those four considerations would be applied to determine whether an item of property is real property or whether it is tangible personal property. And it's a judgment call in applying these four facts and circumstances tests that are given in the latest like-kind exchange regulations. Next, exempt organization executive compensation excise tax. If an exempt organization of the particular type and kind covered here pays an executive more than $1 million, it means actually a key employee more than $1 million a year, there's an excise tax on that remuneration in excess of $1 million, and any excess parachute payment paid to an applicable tax exempt, paid by an applicable tax exempt organization to any covered employee when they're terminating their employment. So there are two key terms here. What is applicable and what is covered, right? I've been doing this a long time. I know how to pick out the key terms. What is applicable? An organization that is exempt from tax under Section 501A is a farmers cooperative organization described in 521B1, has income excluded from taxation under Section 115.1, and that is an unusual citation, but that's it, or is a political organization described in 527E1. Go back to and make sure you get a good take on items that are exempt from tax under Section 501A. I think you'll find that's a larger class than you initially recognize. Then what is covered? Any individual who's one of the 5 highest compensated employees of the applicable tax exempt organization, the ATEO, for a taxable year, or was a covered employee of the ATEO or any predecessor for any preceding taxable year beginning after December 31st, 2016. That could be a very broad class. Next, an S corporation was not entitled to research credits, so it couldn't pass them through to its owners. Edward Tangle, TC Memo 2021-1. The S corporation was not entitled to research tax credits for qualified research claimed and passed through to its owner. Why? The project and the related research was completed under contract for a customer. That contract provided that all rights to the research were property of the customer. And in this case, the customer funded the research. Mr. Tangle's S corporation had got no rights in the research, did not retain substantial rights of any kind, and the statute very clearly says that qualified research does not include funded research. So, go back to the second paragraph. There are no tax credits for anything except qualified research. If the research cannot be qualified, if it's funded by the customer, then there are no credits to pass through to Mr. Tangle from his S corporation. Pretty straightforward stuff when you break it down. It only looks complicated when you read the head note. Penalty deduction regulations. We live in an age of penalties. Penalties for this, penalties for that. There are rules now here for 2 code sections that were either seriously amended or introduced in the Tax Cuts and Jobs Act. 6050X is a product of the Act. 162F was amended. So let's talk about the code sections. Code section 162F expands the limitation on deducting fines and penalties to include fines and penalties paid under the government's direction, as well as those paid to the government itself. So if I am ordered by an agency of the government to pay a fine or penalty, to pay a penalty, that may not be deductible. There are exceptions. The new law creates an exception to the exclusion for amounts paid as restitution, remediation, or for coming into compliance, and that's important. If I killed 1,000 fish and the fine is $10,000 and the remediation for replacing the fish is $5 a fish, then the $10,000 fine is not deductible, but the $5,000 that I pay for replacing the fish is deductible under this section of the Internal Revenue Code. Deductions for disgorgements or forfeitures are allowed. I can deduct it if they satisfy all the normal requirements, but they're limited to the taxpayer's net profits. I can deduct a disgorgement or a forfeiture up to the amount of my net profits from the transaction, but no more than that. Those two types of payments can't qualify for the restitution exception if, pursuant to an order or agreement, the amounts are disbursed to the general account of the government. So if the general account of the government gets the money, the payments are not deductible. If the harmed party gets the money, restitution, then the payments probably will be deductible. And then there's Code Section 6050X, which requires a government agency that gets the money or orders the restitution to tell everybody about the transaction. So you're going to get a document from a government agency that attests to your penalty or your restitution or your forfeiture or your disgorgement, exactly what kind of payment it is, which should tell you under the regulations under 162F whether any part of it is deductible or not. Partnership income from discharge of indebtedness. Okay, let's talk about the partnership rules for capital accounts and loans and whatnot, okay? A partnership borrows money. Each partner is deemed to have contributed money to the extent of that partner's share of the debt. We all agree on that, right? In this case, the partnership in which Michael Hull was a partner, there are 30% each partners did not contribute any money. One 10% partner contributed $265,000. Now, if that $265,000 is a loan, then each partner is deemed to have contributed 30% of that, right? So now the partners reported guaranteed payments and losses. They operated the partnership for 4 or 5 years. They used up all of the 10% partners' money. The 10% partner's money was never recorded in his capital account. So if it wasn't recorded in his capital account, what was it? Failure to follow the capital accounting rules here, the IRS says it's a loan. The tax court said, yeah, it looks like a loan to us. And so the loan is repaid. Well, wait a second. These 30% partners had claimed basis, took losses, and now the loan is repaid. When the loan is repaid, it's a deemed distribution to those same partners who were deemed to have contributed it. But they got zero basis. Now they've got a deemed distribution. They've got income. Cancellation of indebtedness income. However you cut it, whatever you want to make it, cancellation of indebtedness income or income under the general application rules of partnership capital account accounting, they also failed to follow their operating agreements provisions for contributing capital or maintaining capital accounts. In other words, they were sloppy. Now, I want to have a word with you, because if you're like most of us, you have not been taking your responsibilities for partnership tax return preparation seriously enough. What do I mean by that? I mean that we should not agree to prepare a Form 1065 unless we have a copy of the partnership agreement in the partnership's permanent file, and as part of preparing the return, we should try our best to determine that the partnership is following the partnership and the partners are following the partnership agreement, so that we don't have this kind of an ugly surprise. And I assure you, Mr. Hull and his 2 other 30% partners think of this as an ugly surprise. Final health reimbursement arrangement rules on combined coverage. To write a lot about this would have been too complicated for the slide. You know who you are. If you have a client that has a health reimbursement arrangement, that's an HRA is a health plan that reimburses only certain specified things. The one I'm most familiar with is a health reimbursement arrangement that pays for vision, pays for LASIK surgery. For any employee that wants to have LASIK surgery, the HRA will pay for it. But if you don't have LASIK surgery, there's no money in the HRA for that. So if you have an HRA, does it satisfy the basic non-discrimination rules? Can you have one of those and still have a group plan? Employers are instructed to assume the silver level plan and integrate their HRA with an assumed silver level plan to make sure that they don't violate the non-discrimination rules. You've got an account-based group health plan. You've wiggled in an HRA, and you don't want to lose the benefit of the non-discrimination rules. So the final rules also provide some safe harbors for employers that are making a diligent effort to comply. Finally, this week, reasonable basis versus reasonable cause. Is there a difference? Yes. According to the U.S. District Court for North Texas Dallas Division, there is a difference. But caution, this decision, and I really recommend it as reading, it's a teaching moment. This decision applies pre-2015 amendment law. Its value is in the analysis of reasonable basis that is contained in the opinion. Exxon had a reasonable basis for its return positions. Therefore, under the law as it currently exists, if Exxon had a reasonable basis, they were only required to disclose on a Form 8275 that they had taken this return position and disclose how they determined they had a reasonable basis. These transactions were sales and not mineral leases. Exxon established that to the satisfaction of the court. And a change in treatment was not a change in accounting method for this particular class of asset, and the amortization of leasehold costs or the treatment of sale proceeds. The decision contains what I think is an extremely useful analysis of the tests for evaluating a position under Section 6662. Now, these two sections are unfortunately too often thought of together. 6676 is about a reasonable basis and was then. 6662 is about a reasonable cause. They're different, just different enough to cause trouble. So only under Section 6662 at that time was a subjective analysis required. So if the claim had a reasonable basis, an inquiry as to the taxpayer's motive and state of mind was not relevant. Under reasonable cause, there is a legitimate inquiry into the taxpayer's motive and even the taxpayer's state of mind. With that, that's a wrap for this week. I really enjoy this time with you. Thank you for joining me every week. And until next time, please stay safe. We need all of you.